So let us continue with lesson 2 of partnership account, conversion of partnership to limited company. So we are going to do a question for August 2024, question number 4B. So August 2024, question number 4 boy. Question number 4 boy. So let us do this question for August 2024. August 2024, question number 4B. And the question reads that John K. and Lynette have been partners have been into partnership business for several years, sharing a profit ratio of 5:3:2. So I will call them the JKL. Let me call them J, K, and L. 5:3:2. That is their profit sharing ratio. That is the profit sharing ratio. They also allow 10% interest on fixed capital balance. No salary and commission were paid to the partners. So we have the trial balance for the year ended 30th June. So the account ends in 30th June. June is 6, 2024. So meaning start at 1st 7, 2023. The account starts in July and ends in June. So we have the trial balance there. Now, and then we have additional information. Let's start with the additional information number 1. The partnership was converted into limited company, JKL Limited, with effect on 1st July. 1st July. So it was converted into 1st July 2024. 1 day after the end of the year. That is a day after the end of the financial year. Now the purchase consideration was the purchase consideration of the business purchase was agreed to 150 million, and a new company issued 15 million each at 10. So remember our account will be in 1,000. So purchase consideration, they agreed 150 million. And how do they do that? They issue shares of 15 million times 10 each. So to become 150 million. So 15 million shares, each trading at 10 shillings. Now, and then that one was to satisfy purchase consideration. So this one was to pay the conversion. So it was to pay the partner so that they becomes the so as to form the shareholding of the company. So the partners were paid 150 million so that they form the shareholding of the company. That is okay. Next, equity investment were taken over by the partners at a new fair value of 18 million and allocated to partners in their profit and sharing. So the equity investment, that is an asset. We shall also close that book later. Number 3, loan from partners Kevin was transferred to the new company at its carrying amount. So the loan amount was transferred to the company at its carrying amount. Other liabilities and assets of the partnership were taken over by the company as follows. So we have them there. Then we have what we call the company issued another 2 million shares. So we have another issue. 2 million each at 10. So that is 20 million. Kenya shillings 20 million. So they issued 2 million shares, each trading at 10 shillings. The proceeds from this issue were utilized to settle the overdraft and loan. So this one were used to settle. So they use this money to settle bank overdraft and loan. So the loan that was there was paid through. So the bank overdraft and the loan was paid through this issue by the company. Now let us start now. We start from the appropriation account. So because it was there at the end of, so this conversion will take place during the end of the year. There is no apportion that is required. So let's go direct. Appropriation account. Appropriation account. Appropriation account. So we start with the net profit. Net profit. So remember it is in thousand. So our net profit in our trial balance is the first one, 42,800. 42,800. There was no any item in our additional information which affects the net profit. For example, depreciation. So there was no any depreciation or any other expense in the additional information. So meaning we just allocate. So we less interest on capital. Interest on capital. So we less interest on capital. So we have JK and L. JK and L. So each 10%. So the interest on capital was 10% from the first paragraph. Now let us go to the trial balance and see the capital. Now the capital for J in 43,700. Then we have 28,500. Then we have 18,800. So that is the share. So this one will be 43,70, 28,50, then 18,80. So what will remain? Profit available for sharing, and we share according to their ratio. Profit available for sharing. Available for sharing is 33,700. Then let us share. So J, K, and L. So it is 5:3:2. So 5/10, 3/10, and 2/10. 5/10, 3/10. So they share this amount 33,700, 33,700, 33,700. So the first one will get 16,850, 10,110, and then 6,740. So that we have a nil balance. So that's how you will share that account. Okay. Now once we share that account, I think it will be important if we open the realization account. Allow me to open in this side so that maybe it will be enough. So realization account. Realization account. Now for realization account, all the assets were taken over at net book value. So remember this account, we input the item on the net book value. Net book value meaning at their carrying amount or their value at as per the trial balance. So let's start with the first asset. Now the first asset I can see is in inventory, or you can start with the non-current assets. Let's start with the non-current assets. Start with property. Start with property. Property. Now property carrying amount is 72,950. 72,950. Yeah. Property. Once we are done with property, there was no any depreciation. Plant and equipment also on their carrying amount. So plant and equipment. So plant and equipment also on their carrying amount. Carrying amount, another name of carrying amount, remember, another name of carrying amount is net book value. the value as part of the balance sheet or the total balance in this case. So plant and equipment, suppose we planted machinery, that's 7,730. That is 7,730. Then we have a motor vehicle 10,580. Motor vehicle 10,580. Motor vehicle it is 10,580. Then we have office equipment. Office equipment. In this case, office equipment in our total balance is 25 to 40. 25 to 40. Then we have equity investment. It's an asset. Equity investment. So you have an equity investment at fair value of 10,000. So the fair value is the market value, which is the same as the net book value. Yeah. Apart from those assets, which asset we have? Inventory. We have inventory. Now inventory is 28,400. Then we have receivables. Receivables 23,800. That is from the trial balance direct. That is from the trial balance direct. I think we have exhausted everything. Now we do liabilities. So we do liabilities. Now liabilities, I don't know why I'm writing liabilities. Let's start with the payables. Payables is our common one. So let's continue from our trial balance. So payables is 32,700. 32,700. Okay. Once we have payables, we have bank overdraft 6,800. Bank overdraft 6,800. Apart from bank overdraft, we have loan from Kevin. Loan from Kevin is a liability. It was 9,100. Then we have investment now. This investment, this one, equity investment. That equity investment, let's go to information number 2. Equity investment was taken over at a new fair value of 18 million. So it was taken over at a new value of 18 million. So that is the equity. So it was taken over. According to that information, equity. So it was taken over at a value of 18 million and allocated to the partners on the profit and loss sharing. That's okay. Now, one item is remaining. That is the purchase consideration. Purchase consideration. Now, the purchase consideration in this case is information number 1, 150 million. So 150,000. So it is in, remember our account is in thousand. Now then we balance this account, then we share. So I think it will be a gain. So we share on this side. We share for K, JKL, JK and L. So 5/10, 3/10, and then 2/10. So JK and L. Now let us find the balancing figure so that we balance this account. Now when we add the other side, 150 plus 9,100, so that's 700 plus 6,800 plus 18 That's 91 plus 150. It will give us 216,600. 216,600. So that will be 216,600. Now the balancing figure itakuwa ngapi? Now we add all this amount, we less to this figure. So the balancing amount should be around how much? We need to do that one. So I'll take 72,950, 37,730, 10,580, 25 to 40, 10,000, 28,400, 23,800. So 216,600 minus answer 7,900. I think that is correct. 7,900. So 5/10 times 7,900, but it is giving us 3950. 3950. Then 3/5, 2370. Then 2, 1580. So that's how you do the relation account. Then we can open the partners what? Current account. Let us open partners current account. Partners current account. Then on the other side, we shall open the partners capital account. So we start with the details. Details. So details. So you have JKL, J, K, and L. Details, J, K, and L. I think that one is enough. So we start with the balance brought down. Now balance brought down for the partnership. So if you go to the balance current account, it is let me check. 14,790, 12,960, and 98,50 in that order. So 14,790, 12,960, 98.50. Now we check interest on capital. Interest on capital means andika in small. So int means interest on capital. So interest on capital, we have it here, 4370, 4370, 2850, and 1880. So that's the interest on capital. We don't have commission. We have the profit allocation, profit share. Profit share from the appropriation account, we have 16,850, 10,110, 6740. Good. So we said we don't have any drawings, so meaning we can balance this account from this end. We can balance this account from this end. Now before we balance, let's see if there is any account which affects the credit side. Yes, we have drawings. So don't forget the drawings. We had drawings. Now drawings, it is in auto balance the last item before the loan to Kelvin. So John 4370, Kelvin 4020, and 2910. So 4370, 4370, 4020, 4020. Then you have 2910. Then if you have interest on drawings, you also incorporate here. So if there was interest on drawings, in this case there was no any interest on drawings, you can incorporate it also in that side. Then we can find the balancing figure. So the balancing figure will be, the balancing figure in this case will be equal to what? To capital. It will go to the company account as capital. It will go to the capital, to company account as capital. So let us add them together. So 9850 plus 15560 plus 1580. That is 20 what? What am I doing? 9850 plus 1880 plus 6740. That is 18 for 70. 18 for 70. 25 920. 25 920. 36 010. So also on this side, 36 010. 25 920. 18 for 70. Now the balancing figure will go directly to company account as the share capital. So balancing figure say to company account as share capital. As share capital. To company account. To company account as share capital. Just a moment. As share capital to company account as share capital. So to company account as share capital. So to company account as share capital. I think that one is not bad. Then, so once we open the partners capital account, you also need to open the partners. So once you open the partners current account, we also need to do the same for partners capital account. I think it will enough. It will be. So this space will be enough. Partners capital account, and then on the other side we shall prepare what we call the opening balance, the opening statement of the financial position. So we start with the details. J K L details. J K and L. So we start with the balance from the partners account, from the capital balance brought down from the capital account. So let's go to the capital account for the three partners. So the capital account was 43,700. We have it here. 43,700, 28,500, and 18,800. So 43,700, 43,700, 28,500, 18,800. Good. Then we need to do transfers. So the first transfer is the revaluation, not revaluation, realization from the realization account. Now our realization account transfer is 3950. 3950. This one 3950. Then we have 2370. And then we have 1580. So we have the three. So that's the realization. So realization. Then we have current account balance. So then I'm supposed to go to the made a mistake. Supposed to go to there's a mistake here. Supposed to go to the partners capital account. To partners capital account. So let's balance this account. We did not balance it. So we need to balance this account. So 36,010 minus 4370. The first one is supposed to be 31,640. 31,640. 25,920 minus 4020 is supposed to be 21,900. 21,900. And then 18,470 minus 29,10. Supposed to be 15,560. Now this one goes to the partner's capital account. So this one goes to the capital account as the current, on the credit side as current account. So we call it the current account. Current account. So it is 31,640. 31,640, 21,900, 15,560. That one is correct. Then do we have any other account that affect this account? So goodwill, we don't have goodwill, but we had an investment. This investment at fair value, this one, investment at fair value. So we call them that's investment. Investment. Now this investment, you need to allocate it to the partners. Let's start with J. So J, you can do it where? Let's do it here. So J, this one is for the investment. So it is J is 5/10 times 18,000. K is 3/10 times 18,000. Gen L is 2/10 times 18,000. So how much would that be? So 5/10 times 18,000. It's giving us 9,000. So that is 9,000, which will come here. 9,000. 9,000. Then 3/10 times 18,000. 5,400. Also 5,400. Then 2/10, that's 600. Also, that is 600. Now, I think there's no any other account that affects that account. There is no any other account that affects that account. So we balancing figure will go to the company account. So the balancing figure. So the balancing figure will go to the. So we'll go to the company account. We'll go there to the company account. So let us find the balancing figure to company account. To company account. So as share. So let us balance the account. So let us balance that account. Where is my calculator? So 18,800 plus 15,880 plus 15,560, it is giving us 35,940. 35,940. 35,940. 28,500 plus 23,70 plus 21,900 is giving us 52,770. 52,770. And then 43,700 plus that 1,640 plus 39,50. 79 to 90. 79 to 90. 79 to 90. So the first one, obviously, to the company account, it is 70 to 90. If we remove 9,000, so it will be equal to 70 to 90. We remove the 9,000. The other one will be 47,370. 47,370. Then 32,340. 32,340. That one is correct. Now we can open the company account, the JKL company account. So JKL limited account. So we have the purchase consideration. So when you add this one plus this one plus this one, it must give you this one. So it must give you that one. Let us confirm. 70 to 90. 47,370. 32,340. Yes, it's giving us 150,000. That is the purchase consideration. 150,000. So meaning this one is J, K, and L. Total is supposed to be 150 million. So remember it is in thousand. So it's supposed to be 70. It must balance to 90. 47. 370. 32. 340. So 150,000. Good. Now once we do that one, you can also do the cash account before you do the cash account. So we start with the balance brought down. So do you have any cash in our? So there was no any cash in our account. Let me confirm. There was no any cash because it could have been here in our realization account. So there was no any cash account. There was no any cash account at any point. That one is correct. Now let us see our issues. So number one, information number one. The purchase consideration on the business purchase was agreed to be 150 million, and the company issued the 15 million shares at 10 to fully satisfy the purchase consideration. That one is correct. So we say issue of shares. So there was issue of shares of 150 million. The reason is was for to pay purchase consideration of 150 million. So it was there, they issued so as to satisfy the purchase consideration. Yeah. Number two, that one is not of concern. Number three, not of our concern. Number four, not of our concern. Number five, the company issued 2 million shares, each 10. So we also have another issue. Another issue. So 2 million shares times 10. That will be equal to 20 million. 20 million issue. So there was an issue of 20 million. Now this issue was there to pay something. The proceeds from the issue were utilized to settle the bank overdraft. So it was there to settle the bank overdraft. So bank overdraft will how much? 6,800. So it was paid from the issue. It was also issued to pay what? Loan. The loan that was taken over. So they paid from the issue. So the loan was 9,100. So we get the balance carried down. So that will help us to get the cash account balance. So let us see. This one is 170,000. 170,000. So 170,000 minus 150,000 minus 6,800 minus 9,100. So this one is 4,100. So we are done with the cash account. So we can open our balance sheet. Opening a balance sheet. So we say JKL Ltd. So we say JKL Limited. Opening statement of the financial position. Opening statement of financial position. Position as at, so as at 1st July 2024. So these are the non-current assets. Remember our figures in thousand. So let us go and see the assets that were taken over from our account. So we have the property, plant and equipment. Property 74. That is additional information number 4. Additional information number 4. Property 74,560. Machinery 35,200. Motor vehicle 95,20. Then we have equipment 23,660. So start with the property. Property 74,560. Plant and machinery. So plant and machinery 35,200. We have motor vehicle 95,20. Remember that's the foundation information number 4. We have office equipment 23,660. Then we have another. We need to add another one, goodwill. Goodwill. In that case, then you go to current assets. We have inventory. Now let's go to the inventory. Inventory, well, they said the inventory at book value less 15%. So we need to less 15%. So meaning, if we less 15% from 100%, it becomes 85%. So inventory will be 85% of the book value. The book value is 28,400. 28,400 here. Then we have receivables. Now receivables, they said that receivables will be at book value less 10%. So we less 10%. Minus 10, meaning it is 90%. So 90% of the receivables, 23,800. Now that's correct. So this one will be equal to 24, 140, 21. For 20, you can confirm with your calculator. 0.85 times 28,400. 24,140, that's correct. And then 0.9 times 23,800. 21,420, that is correct. That one is quite correct. Now we have this one, cash, which it's a new cash now, 4,100. So that we can get our total assets. But remember, we don't have our goodwill. Then we can do equity and liabilities. So we start with the ordinary share capital. We had 2 issues. So we had the first issue of 150 million. This one. And we have another issue of 20 million. So 20 million. So it will give us 150 million. Now we don't have non-current assets, non-current liabilities. So we don't have non-current liabilities because the loan was paid. So the loan was paid. So we go direct to current liabilities. So bank overdraft. So bank overdraft is a current liabilities. We don't have it also because it was paid. So the only thing that we are remaining with is the payables. Payables. Let us go and see payables. Now payables, the current liabilities were at book value. So at book value meaning they were at the net book value. So how much was it? Payables 32,700. 32,700. So this one you get the total asset, total equity and liabilities. Total equity and liabilities. Total equities and liabilities. So let us add them together. So 150,000 is supposed to be 170. So 170,000 plus 32,700. 202,700. So it means this one is 202,700. You can get a balancing figure. Let us try. So we can take 74,560 plus 35,200 plus 95,20 plus 23,660 plus 24,140 plus 21,420 plus 4,100. So 202,700 minus answer. So this is supposed to be 10,100. 10,100. So that one marks the end of that question. We can also use this formula, purchase consideration, which will be equal now to this total amount, 170 minus total assets minus total liabilities. You need to get the same amount of 10,100. 10,100. So anyway, in that case, that one will mark the end of conversion of partnership to limited company. Make sure you do a lot of questions. I will add one more question for your review, but that one I will add it later. As for now, just familiarize yourself with this question very well so that you get to understand the format. But it is quite a simple task. Does not require a lot of things. So you need to remember how to prepare the appropriation account. But before you prepare the appropriation account, make sure you check if there is any item which affects this account. For example, depreciation that is there in the additional information, or it is in additional information. So any item which is in additional information which affects the net profit, you need to adjust it. Then to prepare partners account, partners current account, the partners capital account, that one is easy because you did it in your previous level. That is in financial accounting. And then to prepare the balance sheets, it is normal, just an opening balance sheet. And remember, for the realization account, every item is prepared at their book value, or the net book value. And remember, net book value is the same as the carrying amount, which means cost minus accumulated depreciation. So you need to remember that. So that is mark the end of this class. So let us meet in our next class.